The topic which we are to discuss today is IBC, the interplay between IBC and the tax laws. So I'm covering the income tax laws and the GST laws. So I have a presentation in which we are discussing various provisions of the Income Tax Act which are relevant as far as the IBC is concerned. Also, the provisions which we need to keep into account when we are drafting a resolution plan or when we are giving effect to a resolution plan. So the provisions of the Income Tax Act which are relevant, and the provisions under GST, the various case laws which have been discussed or which have come in regarding the moratorium, regarding the treatment of claims and so on. So we'll be discussing all that. In case anybody has any comments or they want to add any of their own experiences, you feel free to do that during the session itself. We need not wait till the end of the session. So if anybody has any practical experience or they want to share something, feel free to do that. I'll just share my screen now. I hope the screen is visible. I'm aware it's a post-run session, but a little interaction would be helpful. Thank you, Mr. Vikram. Okay. 1 second, something is there on the screen. Yeah. So let us discuss the interplay between IBC and tax laws. A brief background about IBC. I'm sure we all of us are more than aware about this. We have discussed this in the so many times in the last almost 10 years now. We are in 2025 is ending, and this law was introduced in May 16. So it's almost 10 years now. Although it came into effect in December 16. But this law was introduced as a consolidated insolvency framework, because before this we are aware that there was no specific law which was there, which was governing the insolvency framework in India. So there were different laws catering to different kinds of insolvencies. Typically, we had to go to under 433 to the high courts to deal with inability to pay debts and so on in case of companies. So all of that was consolidated in the 2016 in this code, and which started providing for insolvency resolution of companies, LLPs, and for individuals. Right, we are aware individuals only who are corporate, who are guarantors to the corporate debtors, only those are covered for the time being. However, in days to come, it is likely, or days, months, whatever, it is likely that this may be extended to other individuals also, but the framework is yet to be notified for that. It provides for a time-bound resolution process, 180 to 330 days. By virtue of the Supreme Court judgment, it should not exceed 330 days. Although in most of the cases, we have seen that it may not get over in 180 days. 330 days is also kind of sometimes a little bit difficult to achieve. However, that is what has been stipulated, as we are aware. It supports the revival of business or the orderly liquidation if revival is not possible. Now, when we had these previous laws which were there were a lot of obviously it was not time bound. I have personally dealt with a couple of cases, even in voluntary liquidation, which went on for more than 5 years when it was with the High Court. So definitely this time bound to some extent it is working, but at the same time, in case of SIC companies, like we had an old act of SIC Industrial Companies Act, now everything has been clubbed into one. So it is a chance of revival. And the benefits which are available under the SIC Industrial Companies Act, which used to go on for years together, at least that is not required now, in the sense that is the valuation of the assets or does not deteriorate, because it takes ages. It used to take ages under the SICA to deal with those assets. Now, because of this time-bound process, at least as compared to what was the situation earlier, the revival is possible within that given time frame. If not, at least it goes into liquidation in a proper manner. As I mentioned, this timely resolution to prevent the value erosion of the assets. It also maximizes the asset value for the stakeholders, because if the assets are lying for say 5 years, 10 years, and the banks are also not able to realize those assets, when it was before the High Court and so on. Those assets used to lose their value and the banks used to recover very less amount. So as compared to that now, there's a definite possibility of maximization of asset value for various stakeholders, which also again includes the act also tries to balance the interest of the creditors, employees, and the government. So the primary shift that we have seen in the mindset as compared to pre-IBC and the IBC era is a shift in mindset of the government. We all know that that used to be termed as a crown debt. So now they are operational creditors. So we see the paradigm shift which is there in the uh, attitude of the government as regards their preference in case of an insolvency or in case of a liquidation of a company. So previously they used to be treated as preferential debts. However, now they are only operational creditors. And this is something which is in the beginning, I would say, when the act came in the first 3-4 years, there was a huge I would say the employees of the government at the, I would say at the ground level were not really aware that this has changed, and that used to create a lot of problems for us as RPs when we were implementing or when we were trying to explain the situation to them about their claims and so on. But I would say now things have been fairly settled. They have also undergone training programs and so on, and more or less now even the employees of these departments are also aware that how critical it is for them to come and file their claims in a timely manner, failing which we have seen in so many cases that if the claim is not received before the due date, then their claims cannot be accepted, be it liquidation or be it CIRP. So in that sense, that awareness has really grown, and that has also brought in a discipline, which makes ultimately our life simpler. Because imagine I'm sure we all would have gone through the situation where the PF claim came in very late, a GST claim came in late, income tax claim came in very late, and then managing the different things, because sometimes these typically these income tax and the GST claims, they could be high value claims that rearranges your entire list of creditors. So sometimes they may exceed your 10% also of the total debt. Then making them part of the COC without voting rights and so on. All of those things also come into picture. So that is something which is now, because of that discipline, at least they have started filing their claims on time. If not within the first 14 days, at least, before the resolution plan is put to vote. So as per that regulation. So all of those things have definitely brought in a change in mindset, which is a very welcome change as far as we are concerned as IPs. Our role in the process, we are aware, as an IRP, we have one set of actions which we need to do. As RP, we have some different set of actions which we need to do. So all of those things we are required to follow during the CRP process. Also, during this process, we are also required to ensure the compliance with various tax and regulatory laws. So which we will discuss in during the course of this discussion today. What all compliances are we required to deal with under the Income Tax Act and under the GST laws? One of the most important provisions which helps us in carrying out or in deciding the claims or in taking various actions is the Section 238 of the IBC, which says that IBC will have an overriding effect over any other laws if wherever there is anything inconsistent which is there. So the provisions of this code shall have effect notwithstanding anything inconsistent therewith contained in any other law for the time being in force, or any instrument having effect by virtue of any such law. So all of this helps us to effectively take decisions wherever there is an overriding effect. Typically, this would be uh, relevant in the case when we need to accept claims, we need to reject claims, or where we need to approach the NCLT for various I would say various reliefs what are required during the course of the CRP process. So this 238 is a very, I would say, very handy kind of a provision which we are able to use. So again, as under 238, the CRP process is protected from any conflicting statutory demands, because all of these laws, the Income Tax Act, the GST Act, and so on, they have their own provisions and they have their own procedures which are prescribed. Now, by virtue of the Section 238, since if there is any conflicting provision, then we know that 238 has an overriding effect. So the parallel proceedings and tax recovery processes are in that sense uh, avoided. because not every act has brought in these, I mean, like the Income Tax Act or the GST Act has not brought in all the amendments which ought to have been brought in by after the IBC came in. So in all of those cases, we can take refuge to Section 238 and avoid those inconsistencies which may be there. Now, let's start with discussing the provisions of the Income Tax Act vis-a-vis IBC. Some of the provisions of the Income Tax Act were modified to align with IBC. So we know those 13 schedules which are there, so out of which the Income Tax Act was modified. However, not all the amendments have come in, but then we can always take recourse to 238 and say that IBC has an overriding effect. So under the IBC, the tax departments are required to file their claims. The formats are prescribed. Now, even though the formats are prescribed, now we have recent NCLAT judgments which say that the format is not very important as long as the claim and the supporting documents have been received. So even if some creditor files their claim in a format which is other than the specified format, as RPs, we are still required to accept that claim. Uh, Assuming that the documents which have been submitted, the supporting documents and everything is in order. So even though those the specified format may not be followed, but the departments generally are submitting the claims in the format which has been prescribed. Only thing is sometimes there's a mix up between the claim form for liquidation and claim form for CRP. However, as long as the supporting documents and everything is there, we can accept the claim to the extent it is acceptable. The tax authorities are treated fairly as operational creditors. So whatever opportunity is given to other operational creditors is also given to the tax authorities. Again, the change between the preferential debt and the now as operational creditors, that has been settled now. So the tax authorities are also required to file their claims as in like any other operational creditors. Let's look at the first section on section 140 of IDA. So this is not really in any specific order, these sections. It is just a point of discussion what all sections we need to be aware of. I'm sure most of you are already aware of all these sections, but this is just kind of a refresher or having everything at one place. Or in case somebody is not aware, then at least this can add some information which you can probably go and add on to it later on. So verification of return. We know that every company is required to file their returns under the Income Tax Act. So there's an amendment which was brought into section 140 by bringing in 140 C that wherever a company is undergoing CIRP by virtue of the application which is admitted under section 7, 9 or 10, then the return shall be verified by the insolvency professional. So during your CIRP, if your year is getting over and if it is a period when you need to file the returns, it is our job as an insolvency professional, as RP of that company, to verify the return which is being filed with our signature. So in this case, the responsibility shifts to the IRP or the RP instead of the directors. Previously, the directors used to sign the return, but now the responsibility is shifted to the RP and we are able to verify the return. This ensures that there is no discontinuation of the filing of returns during the CRP process, because sometimes the CRP may overlap or go into more than 1 year also. In that case, the company would be at a loss. That is, a corporate debtor would be at a loss in case the returns are not filed. And even any resolution applicant who comes in tomorrow, he may also be at a loss because of the non-filing of returns. So it is critical to maintain that compliance and ensure that we comply with those laws. In any case, as RP, we are required to ensure that the corporate debtor is in compliance with all the laws which are applicable to it. So this is one of them, where we need to ensure that the returns are filed on time. So in addition to the income tax return, that is the final return at the end of the year, we also need to file the TDS return. So assuming that the company is a going concern, the various operations would be carried out by the companies. In that case, the TDS returns and so on, the GST returns and any other statutory filings which may be there, like the PF returns or any other returns, we are required to ensure that those returns are filed on time as per whatever is the periodicity of those returns. If that is not done, then it is not only a violation of that specific law, but also a violation of our duties which are prescribed under the code. So we are required to ensure that all of these returns and under these various laws are filed on time. So the pre-IRP and the pre-CIRP and the post-CIRP filings as RP or IRP, we are not required to we are not responsible for the defaults prior to the ICD, prior to the insolvency commencement date, and the tax authorities are required to file their claims for such dues. We know that the claims are to be drawn up to the CRP commencement date. But during the CRP, we are required to file all the returns. For any previous returns not filed, we may not be able to even regularize them, even if we want to, like say income tax return is not filed for a particular year. Depending upon what the timelines and so on, we may not be able to file those, even though we may want to. So in that case, it is not the IRP's responsibility for prior defaults. We also have section 32A, which talks about the pre-CRP defaults in case of a resolution plan and the change in management. So accordingly, we are not responsible for the prior defaults. But during the CRP, we must ensure that all of this is taken care of. Now coming to section 79, again another very important section, carry forward and set off of losses in case of certain companies. So the section 79(1) states that notwithstanding anything contained in this chapter, where a change in shareholding has taken place during the previous year in case of a company, not being a company in which public are substantially interested, so which means generally a closely held private or a closely held public company, no loss incurred in any year prior to the previous years shall be carried forward or set off against the income of the previous year, unless on the last date of the previous year, the shares of the company carrying not less than 51% of the voting power were beneficially held by persons who beneficially held shares of the company carrying not less than 51% of the voting power on the last day of the year or years in which the loss was incurred. Basically, what it means is that there should be no change in shareholding should not be more than 51%. As it's 51%, to be eligible to carry forward the losses of that particular year, you should have the shareholding should remain unchanged, at least to the extent of that 51%. Now we are aware that in case of IBC, in case of a resolution plan, necessarily, unless it's a MSME and the same set of shareholders or the same CD is again filing the resolution plan and which is approved, usually there would be a change in shareholding. So in that case, it would be, there was a problem in the sense of how those losses should be carried forward. So accordingly, Section 79(2) was brought in, which gives an exemption in these cases. So 79(2) says nothing contained in subsection 1 shall apply to a case where the change in the said voting power and shareholding takes place in a previous consecutive. So this is by way of gifts and so on. Transfer is by way of a gift to any relative and so on. Second is by virtue of the subsection B, is by virtue of any change in shareholding as a result of the amalgamation or demerger or so on, any kind of restructuring. And subsection C, which is there, subclause C, which is there. So the 79(2) also says that subsection 1 shall not apply to a company where a change in shareholding takes place in a previous year pursuant to a resolution plan approved under IBC. Now there are these words after that, which I've highlighted in red, after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner or commissioner. Now, what this entails, these last few wordings entails is that the resolution plan, the notice of the resolution plan before it is approved must be given to the income tax department. Otherwise, how are you going to give a reasonable opportunity of being heard to the principal commissioner or to the commissioner? However, if we see in practice, there is no need, even in the NCLT also, there is no requirement to give a copy of the resolution plan beforehand to the income tax department. If their claim is that the claim will be dealt with as per whatever is the acceptance and whatever is proposed in the plan. But the 79(2) talks about this exemption that in case the change in shareholding takes place in a previous year pursuant to a resolution plan being approved by the NCLT, then that 79, the restriction in 79(1) of that 51% shareholding being constant to be eligible to avail the carry forward loss benefit, that shall no longer be applicable. So cases of a resolution plan approval, that the restriction is not there. This section is effective from 1st April 2018 and it supports the continuity of tax benefits for revived companies. Now this section 79(2), that exemption which was there, is now also extended to subsidiaries under by virtue of the Finance Act 2019. Now this benefit has been extended to subsidiaries and also subsidiary of subsidiary as well. So in case there is a group level restructuring which is happening by way of a resolution plan, so the CD, its subsidiary and its subsidiary, all of them get covered. So this benefit has been extended to all of those entities also. So in case there is a group restructuring or a group insolvency which is taking place, or a resolution plan provides for anything related to the subsidiaries in this manner, then all of that will get covered and that will be exempt from 79(1). Yeah, so the impact on resolution applicants that we discussed, they will gain the tax continuity benefits. They can set off past losses for tax planning, including even taking into account the subsidiary and the step down subsidiary also. Now 115 JB, special provisions for payment of tax by certain companies. So this is what the MAT provisions. So notwithstanding anything contained in any other provision of this act, where in the case of an assessee being a company, the income tax payable on the total income as computed under this act in respect of any previous year is less than 18.5% of its book profit, such book profit shall be deemed to be the total income of the assessee, and the tax payable by the assessee on such total income shall be the amount of income tax at the rate of 18.5%. So this is in respect of companies where the profit is less than 18.5%, then the profit shall be considered as 18.5%. Provided that for the previous year relevant to the assessment year commencing after the 1st April 2020, instead of 18.5%, it has been substituted as 15%. So background of minimum alternate tax, that is MAT. Even if a company shows zero or low or zero taxable income under the normal provisions, it must pay the MAT on its book profits. Earlier, companies could reduce MAT liability only by deducting the lower of unabsorbed depreciation or brought forward business losses. So either of those two could be considered for reducing the MAT liability. This used to create hardship for companies and especially under CRP, because in cases under CRP, usually the company would have both the losses and the depreciation which were there, and only one of them could be deducted. So because of which there was this amendment which was brought in by way of Finance Act 2019, in which a clause was inserted in explanation to section 115 JB, where it says that for companies admitted into CRP under IBC, the rule was changed and both unabsorbed losses and unabsorbed depreciation could be deducted together. So instead of either or, both were allowed. And this was effective from 1st April 2018, that is assessment year 18-19 onwards. Because of which this provided a significant relief for companies under CRP, obviously, because both of those amounts, they could reduce their MAT liability, the MAT burden could be reduced. And it applies from 1st April 18. And as the resolution applicants who are willing or who are interested in submitting a plan, again, depending upon the how much is the benefit which is available, that makes it more, that makes the company or the corporate debtor more attractive for a resolution or for a resolution plan. Another section which was amended was 156 of the Income Tax Act, which talks about the notice of demand. So we know that the Income Tax Department will send out notices, will serve notices on the assessee for any kind of demand which they are going to make. Now, in case of, so what this provision says is that when any tax, interest, penalty, fine, or any other sum is payable in consequence of any order passed under this Act, the assessing officer shall serve upon the assessee a notice of demand in the prescribed form specifying the sum payable. So, as a result of any assessment or any other event which may have taken place under the Income Tax Act, if an order is required to be passed, then and if arising out of that order, any tax, interest, penalty, or fine is payable on the assessee, on the company, then the concerned officer is required to issue a notice of demand in the prescribed format under section 156 of the Act. Now, the amendment what has been brought in is that 156A was introduced, which talks about a modified tax demand. So this was introduced in the Finance Act of 2022. Now, in this case, the assessing officer was required to revise the demand in line with the resolution plan. So suppose the income tax department has filed a claim and their claims was say 100 rupees, and under the resolution plan, say only 5% is being paid to the operational creditor. So accordingly, the income tax department will also get only 5%. So they are going to get only 5 rupees. Now, once the resolution plan is approved, the income tax officer, the concerned officer was required to give a revised demand notice for that 5 rupees. So which brings it in line with the resolution plan. So the amount to be demanded from the company was only that 5 rupees. So that revised tax notice is shall be deemed valid under the Income Tax Act. So that 156A gave the authority to the assessing officer to raise that modified tax demand. So which ensures that the smooth implementation and any litigation is also likely to be avoided because of this. Even in the records of the Income Tax Department, the modified tax demand would be available. This also helps in the sense that it protects the SRS from any post-plan tax harassment, because if the old demand still continues to be shown in the in the records of the Income Tax Department, it may lead to future notices, because this is still happening. Even though now we are 7-8 years down in the in IBC, still we have seen cases where post the resolution plan implementation, some companies, the successful resolution applicants still keep on getting notices from certain departments for the previous dues. So typically it would be the local cesses which are there, like the your electricity dues or your property dues and so on. So those are the departments which are still not really onboarded or not very aware about the provisions of these laws of the IBC and what is the impact of a resolution plan, which happens after the plan is successfully implemented, and the treatment of the past dues, because they're not even aware about to file their claims. But in cases of income tax and GST, now the proportion of getting notices for previous dues has reduced a lot in case of successful plans, and once the amount is paid to them. So our assessing officer must conform strictly to the approved resolution terms, and this ensures the faster closure of the CRP cases. So in case of when the company has changed hands under IBC, all the previous, like we call a clean slate principle, the previous dues automatically ought to be removed from the uh, registry or from the records of the income tax department, which may not happen in all the cases as effectively as it should. But with this new 156A, and if they are issuing that demand notice in that one under 156A for only the amount which they are going to get under the plan, then this will take care of all these, I would say, the hassles which we are facing even in the implementation stage. Section 178 of the Income Tax Act in case of companies under liquidation. Now, 178 provides that every person who is the liquidator of the company which is being wound up, whether under the orders of a court or otherwise, or who has been appointed as a receiver, and shall within 30 days after he has become such a liquidator give notice of his appointment to the assessing officer, who is entitled to assess the income of the company. So this is a provision which we are also following typically in case of CRP also, and in case when the company goes into CRP liquidation, or when the company goes into voluntary liquidation also, we are still giving this notice to the relevant in the assessing officer, so that they are also able to file their claims within time. So previously, the liquidator was required to obtain the no objection certificate from the IT department, the pre-IBC era, where the in case of even a voluntary liquidation, that 178 that NOC was required from the income tax department, even for remitting the funds outside. To the shareholders, the surplus, the remittance of the surplus to the shareholders, even in that case, the NOC was required. Now that has been done away with. But necessarily this NOC used to delay the liquidation process, because that procedural requirements and other things, and getting that NOC was a time consuming affair. Now 178(6) has been introduced in the Income Tax Act, which says that IBC liquidations, in the case of IBC liquidations, liquidator need not obtain an NOC from the income tax authorities. So 178 says the provisions of this section shall have effect notwithstanding anything to the contrary contained in any other law for the time being in force, except provisions of IBC. This is an exemption under which the liquidator, in case of voluntary liquidation or in case of a CRP liquidation, need not send that intimation to the income tax department under section 178. Having said that, I would say it is still a good practice to send that out, because in one of the recent cases where I am a liquidator, the NCLT asked for a copy because this was a 2018 case. Still the NCLT asked me to submit a copy of the proof of service on the income tax and the GST departments. And even though I had served it previously, but that RPAD receipt was not available of 2018, they asked me to serve a copy once again right now on this department. So it is, even though this exemption may be there, in my view, it is always better to send out one notice or send out one letter saying that now the company is into liquidation and they may file their claim. Again, we are aware of this 2021 IBBS circular, which is typically deals with the voluntary liquidation, whether the NOC that which clarifies that the liquidators are not required to seek NOC in case of voluntary liquidation assignments, and even for remittance of funds. I think almost all the banks are now accepting only that IBBS circular. They are not insisting on the NOC from the income tax department, because even though this circular is there, the relevant amendments are not there in their internal guidelines or in under FEMA, which talks about the list of documents which are required in case of remittance of surplus or remittance of capital to the shareholders outside. So that list still contains the copy of the income tax NOC from the income tax department. So because of it, the circular has been brought in. Now the circular, I think it is again fairly settled. Most of the banks are not insisting on that NOC anymore. And it has become a very smooth affair to remit the money outside in case of voluntary liquidation. Next section for discussion is section 46 of the Income Tax Act regarding capital gains on distribution of assets by companies in liquidation. So notwithstanding anything contained in this section, where the assets of a company are distributed to its shareholders on its liquidation, such distribution shall not be regarded as a transfer by the company for the purpose of section 45. And where a shareholder of the company on the liquidation of a company receives any money or other assets from the company, he shall be chargeable to income tax under the head capital gains in respect of the money so received or the market value of the other assets on the date of distribution, as reduced by the amount assessed as dividend within the meaning of 222C, and the sum so arrived at shall be deemed to be the full value of the consideration for the purpose of section 48. Now, I would say typically this section would be more applicable in case of voluntary liquidation rather than a CRP liquidation, because most of the times in the CRP liquidation, we don't have money to even distribute to the operational creditors, let alone to the shareholders. So most of the times the amount gets utilized in the case by paying the secured creditors or the wages or to the employees only. We don't even reach beyond 3 or 4. So this is more in case of voluntary liquidation. We know that whenever there is a surplus which you are distributing in case of voluntary liquidation, the differential amount will be treated as capital gains and it will be taxable in the hands of the shareholder. So again, because of this 46, again, no need for a fresh valuation under IBC distributions. It is a straight away calculation which needs to be done. Wherever it is with respect to shareholders in another company, in another country, we also need to look into the double taxation provisions. That is the double tax avoidance treaties. If we are having with any of those countries where the shareholder is located, then we will take the tax rate for deducting tax accordingly in your 15 CACB. If there is no DTA, then we will do it at the whatever is the tax which is applicable, the capital gains rate which is acceptable or applicable at the time of distribution. So the withholding tax will be deducted accordingly and paid by the liquidator, and the balance money will be remitted to the shareholders. Now, section 281 of the Income Tax Act, which talks about certain transfers to be void. Now, where during the pendency of any proceeding under this Act or after the completion thereof, but before the service of notice under Rule 2, any assessee creates a charge on or parts with the possession by way of a sale, mortgage, gift, exchange, or any other mode of transfer of any of his assets in favor of any other person, such charge or transfer shall be void as against any claim in respect of any tax or any other sum payable by the assessee as a result of completion of the said proceeding or otherwise, provided that such charge or transfer shall not be void if it is made for adequate consideration and without notice of the pendency of such proceeding, or as the case may be, without notice of such tax or other sum payable by the assessee, or with the previous permission of the assessing officer. This section applies to cases where the amount of tax or other sum payable or likely to be payable exceeds 5,000 rupees and the assets charged or transferred exceed 10,000 rupees in value. Now, what this means is Income Tax Act empowers authorities to void any asset transfers where the tax dues are pending. This creates uncertainty during IBC resolution, obviously, because there would be tax dues which are pending. And in case under the resolution plan, if these assets are transferred by way of the resolution plan, then that may create uncertainty as regards section 281. But again, even though 281 has not been amended, we again take recourse to section 238, which talks about overriding powers of the IBC. Accordingly, that 281, that void transfers we can will not be applicable for transfer of assets. Now, section 80A, submission of return for losses. So section 80 talks about notwithstanding anything contained in this chapter, no loss which has not been determined in pursuance of a return filed in accordance under subsection 1 of 72 or 73, 73 or subsection so and so, which means that late filing of return of income results in loss of carry forward benefit. So which we are aware that if you don't file the returns, income tax returns, then the loss, then there is a loss. The companies cannot carry forward the losses. So it is a responsibility of the RP to ensure the timely filing of these returns. And like we discussed at the beginning, if there's any delay or if we don't file that return when we are supposed to file it, then that could affect the chances of the SRA in the sense of getting a good proposal or getting a good resolution plan, as also that would put the SRA at a disadvantage because they may not be able to carry forward these losses. Now, something about the GAR and CRP. GAR we know is the general anti-avoidance rules, that is anti-avoidance, that is avoidance of tax rules. So GAR provisions are target any tax avoidance by in any direct or indirect manner. IBC plans are statutory and hence not tax avoidance measures. So even if though you're taking over a company under IBC by way of a resolution plan and so on, this will not be applicable because it is not a tax avoidance measure. This happens by way of a statutory order which comes in from the NCLT and the resolution plan is approved. So this is exempt. There's a 2000 circular which exempts court-approved plans from GAR. Now, it does not specifically talk about IBC-approved resolutions, but it talks about any court-approved plans are exempt from this. Accordingly, these GAR provisions or that anti-avoidance provisions are not relevant in case of takeovers under by way of a resolution plan under IBC. Yeah, so this we have discussed. Now what I wanted to discuss was the moratorium under IBC. So under section 14, there's a moratorium post-admission which halts all the suits, enforcement and recovery actions and provides a breathing space for the resolution process to ensure that the assets are preserved during the CRP process. So there's a bar on initiation or continuation of any suit proceedings and so on under the during the moratorium period. Now, treatment of statutory debts, like we discussed previously, these debts were treated as crown debts. They were treated as preferential debts. But under the IBC test, it is now a settled principle or it is a settled under law that these are operational debts and they rank below the secured financial creditors. Government must file claims like any other creditor and the resolution plan has binding effect on the government also as it is on other creditors. Now coming to the distribution, that is a liquidation waterfall. In case of section 53, we are aware about this distribution. This itself shows where the operational creditor, that is the government dues, lie in case of a distribution under liquidation. So 53, when we discuss 53, it says that the proceeds from the sale of liquidation assets shall be distributed in the following order of priority and within such period and in such manner as may be specified. So this talks about your assets only out of the liquidation estate. Any assets which are realized shall be distributed in the following order of priority. The first is the insolvency resolution process cost and the liquidation cost paid in full. Unless that is paid, we cannot go on to the next clause, which is the debts which are hanging equally between the workman's dues for 24 months prior to the LCD and the debts owed to a secured creditor who has relinquished his security in section 52. So, which means that he has pooled his assets in under section 53. So, all the assets are there in the liquidation estate. Once all of these are paid off, then we move to the next one, which is the wages and any unpaid dues owed to employees other than workmen for 12 months before the LCD. After paying that, we move to the financial debts owed to unsecured creditors. Then where we first come across the operational creditors. So following dues shall rank equally and among the following. Any amount due to the central government and the state government, including the amount to be received on account of Consolidated Fund of India and the Consolidated Fund of a state, if any, in respect of the whole or any part of the period of 2 years preceding the liquidation commencement date. So here, if you see it, this even between the operational creditors, there is a bifurcation. So here we are talking in E sub clause 1, we are talking only about the central and the state government dues. So operational creditors are not included here. Operational creditors, we again need to go further. That is any remaining debts and dues. But here, within the operational creditors or within the government dues have a better priority as compared to the other operational creditors. So E is equally any of these government dues and debts owed to a secured creditor for any amount unpaid following the enforcement of security interest. So anything which is still outstanding after the creditor has sold the assets under section 52. If any amount is still outstanding, he will come and stand in line here. So these both are ranking equally. If we have 100 rupees, we need to give both that 100 rupees to these two proportionately. After this comes the operational creditors, that is any remaining debts and dues, then the preference shareholders, and then the equity shareholders. So we see in the whole waterfall arrangement, the government dues, even though they may be operational creditors, there's a further bifurcation within that, and they stand at fifth position in the entire hierarchy of distribution. Right. So this was about the distribution under liquidation. Now there are certain provisions here which are relevant in case of a resolution plan. Typically, when the resolution plan is approved, what happens, because generally there is a haircut. In very few cases, are the operational or sorry, the financial creditors going to get 100%. Operational creditors hardly get 100%. They may get 5, 10, 15, 20%. So there is always a haircut either in terms of the financial debts or in terms of the operational debt. So what is the taxability of haircuts when there is a resolution plan which is approved, or when we are drafting a resolution plan, or when we are considering a resolution plan to be submitted for any case? What is the provisions which we need to be aware of and what we need to take into consideration? So we understand what is the meaning of a haircut. 100 rupees is the claim of the financial or the operational creditors, and against which say only 60 rupees are being paid. So 40 rupees is the haircut. So that is the haircut what we are talking about. So there is section 28(4). So any benefit in the course of business or profession is treated as income. So any benefit here in the sense, it means any waiver which because a haircut is a waiver. You were supposed to pay 100 rupees, you are paying only 60. So 40 rupees is a waiver so that is a benefit which has been received. So loan, credit or interest waiver is a benefit and hence taxable. So typically the financial creditors are going to give the company is going to get that benefit, that where they had to pay 100 rupees, they now need to pay only 60 rupees. So that 40 rupees is a benefit which the company has, that corporate debtor is getting. Now that benefit in the course of business or profession is treated as income. Hence it is taxable, is what was held. But however, there is a Supreme Court judgment in the case of Commissioner versus Mahindra and Mahindra Limited, a 2018 judgment, which interpreted that 28(4) is applicable only to non-cash transactions. Since waiver is a cash transaction, because it's actually the cash which is being waived, and the entry is going to come accordingly, then this 28(4) will not be applicable and tax will not be applicable on the haircut which the company has received in this case. So this was the position in 2018. by virtue of the Supreme Court judgment in Commissioner versus Mahindra and Mahindra Limited. However, because of this position, what was held by the Supreme Court, this led to a 2023 amendment in the Income Tax Act under 28(4), by which now cash and non-cash transactions are also covered. So any benefit which was likely to come by virtue of these cash transactions, as was held by the Supreme Court in Mahindra and Mahindra, that has been taken away. So 2023 amendment says that cash and non-cash transactions all are covered in terms of for that for the purpose of section 28(4). There is also this CBDT circular number 18 of 2022, which says that from the assessment year 23-24 onwards, any exemption from TDS deduction under section 194R for banks, financial institution, etc., for waivers given by them to lenders, so they need not comply with that with the provisions of section 194R for all these financial institutions or any financial service providers in case they give waivers to their borrowers. Now we come to the accounting treatment of haircut. So that what we discussed for 28(4) regarding the tax impact. Now we'll discuss the accounting treatment of haircuts. How are they to be shown in the books? So the Ind AS 109, which deals with derecognition of any financial liability. So in this case, when we are getting a haircut, when that corporate debt is getting an haircut, there is a derecognition of a financial liability. Earlier, you were liable to pay 100 rupees. Now you're going to be liable to pay only 60 rupees. So that 40 rupees is getting derecognized. So derecognition of financial liability is dealt with in Ind AS 109. The difference between the carrying amount of liability extinguished and the consideration paid shall be recognized as a profit or loss. So what it states is that, again, because there is a lot of discussion which takes place, whether this will be treated as a capital reserve or which it will be treated as or recognized as through the profit and loss account. Now, what has been held in Ind AS 109 as well as the expert advisory committee of ICAI is that any of such waivers, when they take place, waivers of loans, they should be routed through the P&L account and they should not be transferred to the capital reserve account. So that is the incorrect treatment. They should be dealt with through the P&L account only. So the difference between the carrying amount of the liability extinguished, which means that the outstanding amount as per the books of the company, and the consideration paid, that is actual amount which is minus the haircut, that amount shall be recognized as the P&L. That is the amount of haircut is recognized as the profit or loss in your books. And that should necessarily be credited to the P&L and not be transferred to the capital reserve. Now, in this case, whether the benefit of section 238 can be taken, because if we consider it in a macro sense, it means that there is a difference between the treatment which is provided under the Income Tax Act, and the 238 says that the IBC will have an overriding effect. However, in this case, that benefit cannot be taken of 238 because all these actions which are going to take place are going to take place in future. Once the plan is approved and after that when the books are drawn, that is when these actions are going to take place, whatever accounting treatments are to be given. So the view is that the benefit of 238 cannot be taken as an overriding effect, and whatever is the liability which is coming in as under the plan by virtue of this particular accounting treatment, that the SRA is liable to pay. So tax on remission and cessation of liability is a post-plan approval event and cannot be covered in waivers and concessions under the plan. So many of the times, if you see, even if whatever is written in the plan, the NCLT will only approve what is the standard practice or whatever is in accordance with the accounting standards. So even though the resolution applicant may write certain concessions which are there in the plan in terms of income tax provisions, they will still not allow that unless it is in accordance with the accounting standards. Now, some case laws about what items have been taken to be taxable. And it is not under IBC. This is generally under the Income Tax Act. Any earnest money of buyer, if it was forfeited, that has been considered as taxable in the hands of the company. Any OTS benefit which was given was also considered. Like if the company has got that OTS benefit by virtue of a one-time settlement with the bank, whatever benefit was received by the company, that also has been held to be taxable. So this is squarely applicable in two cases under IBC also. So whatever haircut is received that will also be considered as taxable. Now, next is the taxability under section 41(1). So 41(1) is attracted in case of any benefit arising from remission or cessation of trading liability. So the previous one was where the loans, where there is a haircut. Now in this case, there are other things which are, or there is a further bifurcation which takes place. The loan or interest is divided into the following categories. Either it's a capital loan, that is a term loan, so which is used for buying capital asset generally. Then there is a cash credit or a working capital loan. Then there is an interest on loan capitalized, and there is an interest on loan claimed as expense. So there are these four categories, and they're dealt with differently. In the Mahindra and Mahindra case, what we discussed previously, the waiver of term loan, it was held that the waiver of term loan amounts to cessation of liability other than trading liability, hence that is not taxable. So obviously this is prior to 2023. So this post the amendment, the situation may change. Then there was a Logitronics case of the Delhi High Court, which held that the waiver of loan taken for trading purposes is taxable. So if the loan was taken, say, as a working capital loan, and if that loan is waived off, or part of that is waived off, then that waiver will be taxable. Again, in line with what we have discussed till now. Then there's a Rola Tenors Limited case, which says that writing of cash credit loan is income and hence taxable. So same thing. So if the loan is taken for any operational purposes and it is written off, then that loan is taxable. However, term loan, if it is waived off, then it is other than the trading liability and hence that is not taxable. Yeah, then the next one is taxability under section 56. Sorry, I'm not able to see this. Yeah, 56 to 10. So under section 56, the following income shall be chargeable to income tax under the head income from other sources. Namely, when a person receives in any previous year from any person or persons on or after 1st day of April 2017, any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. So under 56(2), it says that in these incomes, so if there is a benefit which has been received uh, from any person by a company in any previous year without consideration, then that the aggregate value of that benefit or of that sum of money should exceed 50,000 rupees. In such case, the entire amount of that which is received without consideration, that entire amount will be treated as will be chargeable to income tax under the head income from other sources. So basically that will be treated as income in the hands of the assessee. So this is applicable when the assessee receives any sum of money without consideration. And in case of waiver of loan, no money is received in that particular year, and hence it is not taxable. So this is the position which is held, although there are some things which are conflicting in a sense to each other. Again, the latest legal position will have to be looked into. Till the time that there is no clear-cut provision which has come in the Income Tax Act or any clear-cut clarification which comes in, that whether something is allowed, something is not allowed, whether it will be exempt or what is going to be the consideration or how it is going to be taken. Till that time, this legal position, we'll have to look at the legal positions only. Now, taxability under section 115 JB. So we saw this 115 JB, which was regarding the MAT, the minimum alternate tax. Now, as regards that this taxability under the plan, in case the gains arising from extinguishment of liability are transferred to capital reserve, this treatment is not in consonance with Companies Act 2013, provisions of section 129, second proviso, read with schedule 3 and in days 109. So we discussed that what is provided is that in case of extinguishment of liability, the amount should be routed through the P&L account and not to be transferred to a capital reserve. In case it is transferred to a capital reserve, then it will give rise to a liability under section 115 JB. So MAT under section 15 JB is payable for any book profit that arises from loan waiver as they are required to be routed through the P&L account. So this is something which we must take into consideration while drafting a resolution plan. Then in continuation of that, certain case laws on taxability of these loans and waivers. So taxability of time-barred loans. Time-barred trading loans are taxable. This was held in the case of CIT versus TV Sundaram Iyengar and Sons. So this is not a case under IBC. However, the ratio is which is applicable to these to the IBC cases also, till the time there is specific provisions or a specific chapter comes for the applicability of these provisions to the uh, cases under IBC. Then the question arises whether the interest first or the principal first. So when an amount is being paid under a resolution plan to the financial creditors, whether it should be first applied towards the payment to the payment of interest or to the payment of the principal outstanding. So it was held in these two cases, that is CIT versus P. Chidambaram and CIT versus Maharaja Dhiraj Kameshwar Singh of Darbhanga. In both of these cases, it was held that the payment first is towards the outstanding interest, should be first applied towards the outstanding interest. So accordingly, whatever is the haircut will be dealt with accordingly. Certain important judicial decisions. So the courts have consistently held that IBC overrides other laws due to Section 238, which is has the overriding effect. This has settled uncertainty for resolution applicant and creditors. So now, as we discussed, the law has been fairly settled. Again, the binding effect of resolution plans. The judicial pronouncements confirm that once a resolution plan is approved by the NCLT, it is binding on all stakeholders, including the central and the state governments, the income tax department, and the local authorities. So this ensures a clean slate principle for the SRA. So we also discuss Section 32A, which gives that the company or the corporate debtor or the successful resolution applicant shall not be liable for any past dues which have been of the corporate debtor, and we will start on the clean slate principle. So the cases like Ghanshyam Mishra, so which is like I would say the Bible in that sense for anything to do with the reliefs and concessions which are sought for under the plan. So this case has established that all the statutory dues not included in the resolution plan are extinguished, and it prevents tax authorities from raising fresh or any pending claims for pre-resolution periods. If the department fails to file their claim or they file their claim in a belated manner, I would say this would extend to others also, like the PF department. Now, typically in one of my cases where I was a liquidator, the PF department filed their claim in liquidation 2 years after the liquidation started. So even though I may have wanted to admit their claim, I was not able to admit their claim because it was beyond the period, 30-day period, and we are not allowed to admit the claims beyond the 30-day period. We had money in the account, so when the PF department approached the NCLT and filed an application, we did not object to it. They said that the funds are available, so in case in case the NCLT is going to allow them to file their claim, we can make the payment. However, the NCLT Mumbai bench rejected their claim, said that since they have come up with a delay of almost 2 years after the liquidation commencement date, their claim was rejected. So these departments necessarily have to file their claim within the period. Now, sometimes your claim can also come in after the 14 days during the CRP, but at the time of filing of we know now that the claims can be admitted. The last date is 7 days before the resolution plans are kept for voting. Now, 7 days before that date, whatever claims are received, because if all claims received at the last date, we need to keep on revising the list of creditors, file as many applications with the NCLT for every revision which happens in the list of creditors. And we are not able to really give a final list of creditors to the resolution applicant also. If it does not stop at some point. So 7 days before the plan is put for voting is also in that sense, I would say a difficult task for us as RPs to, keep on modifying the list of creditors. However, for that, what usually is done is that there is a say arrangement clause or say adjustment clause, which is written in the plans, under which what happens is if the certain amount has been given, so instead of what the resolution applicant does is instead of giving a specific amount to each creditor, they will say that this is the entire amount which I have earmarked for the operational creditors. Now, in case any further claims are accepted by the RP, because filing of the resolution plan, we would be taking one cutoff. After that, the resolution plan may go through a number of stages for negotiation and so on, which may take some time. and certain other claims may also be received after that. So they cannot keep on revising the list so many times in the resolution plan. So what is generally done is that there's an inter se adjustment clause which is there typically in case of operational creditors, whereby they say that this is the amount which is earmarked for the operational creditors, and this is what we are proposing to pay to the operational creditors, even individually. However, if there are any further claims which are admitted by the RP, then the RP and the COC has the authority to make inter se adjustments. As in, if we were paying, say, 10% previously to all the operational creditors, and if certain new claims have come in, the IRP, the RP and the COC has the right to make inter se adjustment so that that 10% may become 9%, 9.5 or whatever, so that any new claims also which come in and which are admitted after the plan submission date, but before the plan is kept for voting, all of those claims can also be considered. So then it becomes a duty of the RP that whenever the plan is placed before the COC to see what is the latest list of creditors, and in case that 10% needs to be reduced to accommodate the other creditors, then that also can be done, because otherwise you need to keep on going back to the SRA to say that, make these changes and this needs to be modified and so on. And that will have to be done till 7 days before the plan is kept for voting. So this inter se adjustment clause is in that sense helpful for us also, and so that we don't have to do a lot of back and forth. We can make the calculations as RPs, make the changes whatever is required, and then that would be the final amount which is to be placed before the COC members for approval. So that is something which is at least in that sense, there's a finality of till when you can keep on accepting the claims. And that will include all your government claims also, because even if your PA for your other department has filed a belated claim, because many times it is seen that your PF department will send a notice of inspection only after they receive the intimation of CRP. Now, to what extent is it acceptable? Because during the moratorium and so on, that's a different question. But their claim comes at the fag end of the process. So that is when we need to keep on dealing with all of these things and giving the treatment, because again, it's a PF due, so which is a kind of a social security due, and we need to be able to deal with it in a appropriate manner. So, Gancham Mishra, like we have said, all those waivers and concessions are taken care of. And by virtue of this timeliness in filing of these claims, by that last date, we are also taking care of whatever maximum claims which we can accommodate during the process, including the claims from the government departments. Now, the clean slate principle, section 32A, even under 32A, like we are aware, whenever there's a change in management which takes place as a result of the approval of the resolution plan, the successful resolution applicant is going to get the corporate debtor on a clean slate. Clean slate is to say all the books of accounts will only contain the assets which are taken over by the SRA, the liabilities to the extent they are taken over by the SRA, and all the previous liabilities will be extinguished, which have not been provided for in the plan. So any other operational creditors or financial creditors who have not filed their claims till the last date for filing of claims, all of those get extinguished. And again, we will see typically there's a standard language in every plan which talks about the extinguishment of all previous liabilities. Even though there may be certain claims as per the books, but the claims are not received, there may be some liabilities which are unknown, in the sense which have not come to the previous management also, which have not come to the RP also. All of those will get extinguished by virtue of the approval of the resolution plan. And this language is invariably included in all the resolution plans, so that it is in the true sense a clean slate which takes place. So the SRA is going to write only whatever he's going to take over from the CD, and only those things will be carried forward hence. Now, this clean slate principle conflicts with the income tax department's right to recover the outstanding tax dues, and it creates ambiguity about whether the tax authority's claims are extinguished along with other creditors' claims. Although now the position is settled that all claims are extinguished unless to the extent they are sought to be paid through the resolution plan. So here is where again that section 281 of the Income Tax Act comes into picture, and where we discuss that 281 empowers the ITD to treat transfers of assets as void if the tax dues are pending on the date of transfer. However, with the non-obstante clause at 238, again, it will have a overriding effect, and this 281 will not have force by virtue of section 238. Although this 238 is a judicial interpretation, what we are taking that 238 has overriding effect and so on. However, it would be much better if the necessary amendments or clarifications are brought in the Income Tax Act, not only with regard to 281, but with regard to the other sections which are applicable, what we discussed. And there is a clarity about whether, like the cash or non-cash transactions and so on. If there's a clarity which is given by way of amendments or by way of clarifications and so on, it becomes easier so that the SRAs, when they're taking over a company, they are not met with certain surprises later on. When they go to file the income tax return, they are not burdened with certain other liabilities which were not envisaged. So that would be helpful if those clarifications are available. So other implementation challenges which can come under the code. The IBC's goal of time-bound resolution is often hampered by lengthy litigation extending the 270-day timeline, which we have seen in many cases that 270-day timeline can get extended much beyond that. So there's a possibility that outstanding tax dues could be extinguished during the insolvency process, which could impact the public interest and revenue maximization. Under the IPC, when there is this when a lot of case law is being generated and even the Supreme Court is giving various decisions which are there, even though the Supreme Court decisions and so on will be the law of the land, which need to be adhered to. However, it would be more effective so that any kind of ambiguity and other things are removed if the necessary amendments are brought in the laws, and even the law enforcement officers under these acts or under these departments are trying to implement the law and adhere to the law in its true spirit. Filing the claims on time, not sending out unnecessary notices after the resolution plan has been approved and so on. So that will create a more business friendly and a more it will inspire more confidence in for companies to take over other sick units under the IBC by way of the resolution plans. So a classic case is the Sirpur paper mill case, where the company was admitted in CRP in 2017 and the resolution plan was approved in 2018. The IT department, after the approval of the plan, issued notices for previous AYs, so which was prior to the ICD. Court quashed these notices and held that the plan is binding on the income tax department. So again, the clean slate principle was reiterated in this case, and the notices for previous periods, which was prior to the commencement of the CRP, were quashed. Okay, so this is what we had. I had to discuss on the Income Tax Act. Now there is a second portion which is there of GST, but ma'am, can we take a 10-minute break here and then come back? Anjali madam? Okay, I guess she's not there. So which is 3:15. Can we come back at 3:30? Then we'll continue with the GST
Yes,
portion.
ma'am.
Yeah, thank you, ma'am. So can we continue with the GST part? Just share my screen. Yeah. Now coming to the correlation between IBC and GST. Now again, most of the provisions in that sense of the IBC which apply to the income tax are uh, similar in case of IBC, in case of GST also, because uh, the logic is the same of how GST is treated and how income tax is treated. So again, income tax, we know that it was treated as a operational debt. Similarly, GST is also treated as an operational debt. So, but the other thing which is different in case of GST as compared to income tax is that the whatever we need to do on a regular basis for GST compliance, in terms of the returns to be filed, in terms of the previous summer being blocked and so on, all of those challenges are there. Especially if the companies are going concern, then it becomes even more important that these compliances are done on time, so that the all the parties who are supplying the goods to the goods or services to the company, to the corporate debtor, also get the benefit through the returns which are filed by the corporate debtor in a timely manner, so that there is no challenge to the operations of the company because of any GST non-compliance or any non-availability of benefit to a third party. So as we are aware, it is our duty as IP to ensure that the company is kept as a going concern. Now for that, GST compliance plays a very important role, because without that, the suppliers may become agitated if that compliance is not done properly. And this has happened before the 2020 circulars came in. There were a lot of challenges which were being faced by the suppliers and so on, because the old GST number in most of the cases used to be blocked of the corporate debtor because they had not filed the returns or not paid the GST and so on. And then asking some other supplier to keep on supplying goods or services to the company during the CRP period was a big challenge, because nobody was willing to do that. Now, after that was taken into account, and there are a couple of NCLT judgments also which talk about the position which was there. Then in some cases the RPs had to approach the NCLT to allow or to ask the department to allow them to file physical returns, because the system was not accepting it, and without which they were not able to run the company. So there are NCLT judgments also wherein the NCLT has directed the GST department to accept physical returns because the system was blocked. However, all that has now been, or I can say it's a thing of the past, because the new notification came in 2020, which allowed us to take new registrations, or rather which mandated us ARP, and now under which now we are able to file the return smoothly because it is treated as a separate kind of a entity for the purposes of GST. So we will discuss all those provisions which are there. So pre-CRP and post versus post-CRP obligations under the GST Act. Previously, it was the old management which was responsible for completing the compliances under the GST Act. Post the CRP commencement, it is the IRP or the RP who is responsible for these compliances. If the company goes into liquidation, then the liquidator would be responsible for completing the filing of returns and so on. Nature of dues, previously it was a operational debt, and in case of post CRP, if there's a continuous supply of goods and services which is happening to the corporate debtor, then the expenses which are or the GST which is applicable on the post CRP, that is post commencement of the CRP, that amount is treated as a insolvency resolution process cost, because it will obviously it will be a part of the invoice or whatever process cost which we are incurring for the process. Suppose I'm availing certain security services or I'm availing certain professional services and they are charging me GST on that. That would form a part of the insolvency resolution process cost. Anything which was pre-CRP, that the recovery needs to be done by way of filing of claims in the CRP with the IRP. However, any obligation which arises during the process, that would be a normal recovery by authorities. In the sense, it would be by way of a resolution process cost, and if the company fails to pay the GST on time during the CRP, it would be the RP's responsibility to ensure that that cost is being paid. that taxes are being paid. Moratorium impact is that once the CRP starts, we know that there's a moratorium which comes in place and under which any recovery or any proceedings are barred. In case of a liquidation, the priority of the GST department is lower below the financial creditors, which we have seen in case of income tax also. But once the CRP is over and the company is a regular company, then the CRP, the tax dues again become a priority expense which needs to be met on a month-to-month basis. Otherwise, the GST department, after the company has come out of CRP and has the resolution plan was successful and so on, any dues after that would be the continuing dues, not the pre-CRP dues or the past dues. So they need to be dealt with and paid on time. Moratorium, I will not repeat this. We have discussed this. So 2020, certain notifications were brought in the by the GST department, which ensured that all of these things which we are now dealing with on a day-to-day basis are were informed to internally also, that the pre-CRP dues will be treated as an operational debt. The tax officers must file their claims before the NCLT. Moratorium bars any recovery actions during the CRP, and the GST registration not to be cancelled for CRP companies. Many times we have seen that the GST registrations for companies which are in the CRP used to be cancelled by the department. So this is their internal certificate clarification which was issued, that all of these things should not be done. File your claims as soon as possible. There's a moratorium, so no new proceedings or assessments can be started during this process. And the old registration should not be cancelled for companies which are in CRP. Then once the claim is filed and the claim is admitted as an operational creditor during the CRP, obviously we know that they don't have any voting rights in the COC. Even if their claims are more than 10%, then they would only get the observation rights, but they cannot vote in the meetings. So mostly they will have to rely on the claims or filing of the claims with the RP and following up with the RP for the status. Once the resolution plan is approved, the GST department, like the income tax department, would also be bound by the resolution plan. Whatever is proposed to be paid in the resolution plan, they have to accept that and close any previous outstandings. The basis for the legal basis for treating the operational creditor or for treating the GST department as an operational creditor. Section 520 and 521 define operational creditor as a person to whom an operational debt is owed. And operational debt means any claims relating to goods, services, including statutory dues owed to government or local authority. So this is a claim relating to goods and services also, and it is relating statutory due. So under all of these heads, it falls. It means that the GST dues are legally recognized as an operational debt. Operational creditor status of the GST department. So during the CRP, for pre-CRP dues, we know that the GST department cannot recover directly. Because of the moratorium, they need to file their claim. And once the claim is filed in the prescribed format, that claim will be dealt with by the IRP or the RP, and they will be included in the list of creditors. Now, once the claim is admitted, they will be treated at par with other operational creditors who may be suppliers, other government departments, and so on. The rights are to submit the claims and get their dues considered in the resolution plan. Apart from that, even if they are included in this COC, provided there are financial creditors, then they don't have any voting rights or anything. But if there are no financial creditors, then it would be the only the COC is formed only of operational creditors. Then they may get voting rights in that case. Yeah, the recovery is again subordinate to secured financial creditors in case of a resolution plan as well as in case of liquidation. The GST department cannot exercise any sovereign power of recovery during the CRP. They must act like any other creditors and file their claims on time. If they fail to file their claims within the timelines, their claims get extinguished when the resolution plan is approved. And post-CRP dues, post-CRP GST dues are treated as resolution process cost and must be paid in full. That we are aware because they are incurred during the course of CR. Departments must file their claim in Form B. Otherwise, their claim will get extinguished. That is the 7 days prior to the voting date and so on. Otherwise, the claim will get extinguished. What all is included in the claims? The claims can include the unpaid GST or integrated. It is the amount which is collected by the corporate debtor on sales or services, but which was not deposited with the government. So this is one part of the, I would say, bigger part of the claim filed by the GST department. Then the interest and penalties, the department can also file claim for any interest and penalties that have accrued on the unpaid tax dues. Audit or assessment dues, if the audit or assessment was conducted by the department before the CRP began, and it resulted in a demand for tax, interest or penalties, then that amount will also form the basis of the claim. So claim can be only for that amount also. Taxable supplies for pre-CRP period, any tax liability arising from taxable supplies made by the CD before the ICD for which the tax was not paid, that amount can also be claimed by the department. Any reversal of input tax credit. So any dues which are arising from the reversal of input tax credit or ineligible ITC, which was claimed by the CD before the CRP, can also form part of the claim. So being like any other creditor, they must provide proof for its claim. So which can include the demand notices, the assessment orders, the show cause notices, and so on. The relevant ledger extracts showing the ledger, showing the balance, and the relevant invoices or tax returns. So whatever is available in their records, that can be given as a proof of the claim, along with the claim which is filed with the IRP or the RP. So as we know, Section 14 imposes the moratorium after admission, so which prevents any attachment, seizure, auction, or recovery by the GST officers. So during the course of moratorium, none of these actions can be taken by the GST officers. They are also not allowed to freeze the bank accounts of the CD for any pre-CRP dues, because if you see, typically it was the VAT department and now consequently the GST department, which used to very frequently go and freeze the bank accounts of the corporate debtors. However, under IBC and once the company is admitted and the moratorium is in place, they are not allowed to freeze the bank account of the corporate debtor for any pre-CRP dues. If that happens, as a RP, we can go to the NCLT and seek for vacation of that freezing of those accounts and requesting the department to file their claims. Now, any old GST registration which was there, that cannot be cancelled during the CRP for pre-CRP default. So the old register, sometimes it had happened like before, sometime in 2020 and so on, before the notifications came in for a fresh registration and other things. The previous number was getting cancelled. So which was not allowing the RPs to claim any benefits or file the returns and so on. So these circular numbers, that notification of notification number 11 of 2020 and other things clarified all of these things. The company must remain registered to continue the operations, because cancellation can harm the suppliers and customers who are relying on that ITC. So that number cannot be cancelled. Even if the number is the registration is cancelled in error, the RP may apply for a revocation. The revocation ensures the continuity of compliance and also a disruption for tax credit chain for the buyers. The IRP or the RP is not responsible for any pre-CRP filing of the pre-CRP returns, like in same in case of the income tax. Our responsibility only begins from the CRP admission date, and once we get a fresh registration under this under CRP, after that only our responsibility to file the returns begins under that new number. For pre-CRP default, the GST department must file a claim as any other operational creditor. And the RP must file returns and pay the dues only for post-CRP supplies, so that all past dues are taken care of by virtue of the claim. And again, if there's a resolution plan which comes in and the payments take place under the plan, the clean slate principle will apply, so that when we hand over the company to the resolution applicant, to the successful resolution applicant, we hand him over along with the new GST registration. So he can continue with that GST registration afterwards. Now, like I mentioned, in some cases, before that notification came in, which mandated us to go for a fresh GST registration in case of companies under CRP. There was this deadlock. So where the RP was not able to file the claims, file the returns for the old GST numbers. So consequently, people were not able to get the benefit and so on. So some RPs filed application before the NCLTs for overcoming that deadlock. In several cases, like Hind TEDx or Videocon Industries and R. Ravichandran and so on, the NCLT directed the GST authorities to accept manual filing of returns and tax payments during the CRP and restrained the cancellation of GST registrations and directed the departments to allow portal access for current compliances without the past filings. Now, this is a thing of the past. At that time, there was this provision for a new registration was not there. So, however, it's in these cases, the courts had to direct the GST department to make all these facilities available to the RP to ensure continuity as a going concern. Yeah, this we have discussed. Post CRP compliances, the RP must file the GST returns, the monthly returns, quarterly returns, whatever may be the frequency. Pay the GST on supplies made during the CRP. Ensure the ITC claim for inward supplies. And ensure that the company is treated as a going concern. So even though the company may not be carrying on any business, still we are required to obtain that GST registration because there may be other services which we may avail during this period. So that is something which we need to do even though if the company is not a going concern. Treatment of pending tax litigation. During the CRP, ongoing litigation under the income tax and GST is suspended due to the moratorium under Section 14. Claims that are under appeal or dispute may be admitted as contingent liabilities. Once the resolution plan is approved, all past claims, including disputed tax demand, are extinguished. Now, in case we have kept something as a contingent liability or as a contingent claim, and we have not admitted that claim, be it of the income tax or any other claim, any other operation creator also. When we go for approval of the resolution plan, it is mandatory that all the claims have been dealt with, either admitted or rejected. So we cannot have anything which is kept in abeyance or which is kept under verification. Say suppose in some cases there is a claim which has been filed by the income tax department or the GST department, and we have filed an appeal against that what the order which was passed by the department. And still the department would file their claim so that their claim is on record. Now, such a claim, we cannot keep it under verification. Either we have to admit that claim or reject that claim. If in case there is going to be a resolution plan or a resolution plan is received. The reason being that when we go to the, when the resolution plan is placed for voting, there cannot be any under verification claims. All the claims should have been dealt with. Now, if you are keeping any claim as under verification, then that may give rise to further litigation. Hence, it is insisted that all the claims should be decided either ways. And even if you have filed a claim, even if you have filed an appeal and you feel that you have a good case in appeal also, it makes more practical sense to accept that the claim of the department, even though that appeal may be pending or you can withdraw the appeal also and admit the claim, because whatever treatment is going to be given by the SRA to all other creditors is going to be given to this department also. So accordingly, at least this puts an end to the litigation and the claim will be dealt with appropriately. So whatever is being paid to the other operational creditors, say 5%, 20%, whatever, that will be paid to this department and their claim will be extinguished in that sense. The balance claim will be extinguished. So again, the basis the clean slate principle, rather than because the appeal is pending, keeping the claim as under verification, we should try to admit that claim and give it the same treatment. So that closes a chapter for the SRA also. Once he comes in, he need not deal with these past appeals and so on. Now, once the resolution plan is approved, all the past claims, including the disputed tax demands, are extinguished. So if you admit the claim, the balance amount of that claim will get extinguished and only that much amount will have to be paid by the SRA. Now coming to the new GST registration. So like I mentioned, we need, once the company is admitted into CRP, within 30 days of our appointment, we need to obtain that GST registration. Corporate debtor is deemed as a distinct person. So there's a separate category which is now recognized, and a corporate debtor is deemed as a distinct person, even though it may be the same corporate debtor which already had a registration. Now under CRP, the corporate debtor has a new identity or is deemed as a distinct person for the purposes of GST. So when we are applying for the GST registration, we have to apply as a fresh registration, which we will do with once we get the order from the NCLT. we will be using that order, the certified copy of the order, to obtain that registration. Of course, the list of other documents and so on are required to be obtained from the directors with suspended powers. To the whatever extent we are able to get those documents, we will make an application. I have still seen the as late as last year, like 8 months ago, when I applied for a fresh registration in one of the case, the officer was not aware of the GST or the IBC or the provisions, and under which we are able, under which we need to go for this new registration. So he, on the first instance, rejected the application, saying that this company already has an existing number and why are you applying again and so on. So we had to explain to him, we had to give a written submissions and so on. And after that only we also gave a copy of all these notifications of 2020 which came in the circulars, internal GST circulars. So after submitting all of those, then he allowed the application. So it may not be a very smooth process if the concerned officer is not aware about these changes which are brought in under IBC. But then that is something which we need to do as a part of our IBC for IRP or RP appointment. This fresh registration is to be taken for each of the state or the union territory, wherever that corporate debtor is having business. And if there are no past defaults, then it may not be required. The GST registration may not be required. So like I mentioned, the under this CRP, the CDs are treated as a separate class of taxable persons. So even though it may be the same company may be having a registration, this will be treated as a separate class of taxable persons. From the date of appointment of the IRP or RP, the corporate debtor is deemed a distinct entity from its earlier status and must obtain a fresh GST registration in every state or union territory where it is registered. This must be done within 30 days of the appointment. Debtors already undergoing CRP as on that date, as in March 2020, were given time till 30th June 2020 to obtain that registration. But at that time also there was a huge challenge, because I would say 90% of the department did not know that such a notification has come in, and we had to educate them. Now I would say it is, say, 10% only are not aware. But at that time it was a challenge. So getting the registration till 30th June was also a challenge at that time. The exceptions are whether debtors are with no past GST defaults are not required to obtain the new registration. Once a new registration is issued, the CD must comply with all GST obligations, and we need to use our DAC or whatever for filing of the returns, monthly, quarterly, whatever it is. The first compliance is to file the first return under Section 40 of the GST Act. This return covers the period from the start of the CRP up to the date of new registration. So even if it takes more than 30 days to obtain that registration, whatever other transactions which have taken place from the start of the CRP till the date of the new registration, all of those need to be covered in the first return. Otherwise, later on, you may not be able to claim the benefits which you want to claim under that particular return. So the first return has to go very carefully. Ensure that everything is included in that, especially if the companies are going concern. Then the IRP-RP thereafter has to ensure regular GST compliance, like filing of returns, payment of taxes, and so on. For ITC, a special mechanism has been provided. So input tax credit on invoices issued during the CRP period, even if they were issued under the earlier GSTN, can be claimed in the first return filed after the new registration. Suppose the companies are going concern and it is taking time, or especially the companies in 2020. At that time, the old number was being used. And if there was some ITC which was available, that can be claimed in the first return filed after the new registration. In one of the cases where I was a liquidator in 2000, before 2020, and I obtained that registration in 2020 after the circular came in, and whatever ITC I have claimed, now the GST department has sent me a notice saying that how have I claimed those that amount in the first return, because the notification very clearly says that in the first return, whichever is filed after the new registration, we need to claim everything which was there. However, this was a 2020 case, so everything since the 2018 CRP has been claimed in that. Now that matter is still sub judice. I need to represent before the GST authorities, but still that awareness and everything is not there 100% to the extent what it should be. Now, restrictions under Section 16, subsection 4, that is a time limitation for ITC claim, and the restrictive ITC matching will not apply for this period. So, which is very clear. These notifications are very clearly saying that all of these things will not apply, and you can claim everything in the first return. So buyers who purchase goods or services from such CDs during the CRP can also claim ITC on invoices issued with the old GSTN without being bound by Rule 36(4) because the number has changed, but under the old number, they can still claim that ITC on those invoices which are issued by the suppliers. Any balance lying in the cash ledger of the old registration deposited between the date of IRP's appointment and the notifications issued date can be refunded to the earlier registration. So this is typically applicable at the time of first registrations in 2020. Now it may not be that relevant if the old, especially if the old number has been suspended. But any balance lying in the cash ledger of the old registration and which was deposited between the date of the appointment, that is the CRP commencement date, and the notification issue date, can be refunded to the earlier registration. Now the dues which are there during the CRP process would be treated as the CRP costs for supplies during the CRP process, and they will rank first in the order under liquidation because they would be treated as insolvency resolution process cost. They are given priority to ensure the compliance and to ensure that the company remains as a going concern. Failure to comply with these rules, say the GST is not deposited and so on, then there is RP would be the responsible person for ensuring that compliance. Rules have been given specifically for claiming ITC during the CRP period. So this we discuss the invoices under old GST are eligible for ITC claims and so on. The refund from old GST and the cash ledger refunds are permitted. Applies to deposits made post CRP initiation. And this ensures that the liquidity is there during the CRP. If we are able to knock off the balances in the ledger, then we have that much of liquidity in the process. Because most of the times in CRP, the cash is a problem unless the company is going concern and it has money to meet its expenses. Otherwise, that is a challenge. Having money to spend is a challenge. In case there is a change in the RP, no new registration is needed. The same registration will be handed over by the IRP or the old RP to the new RP. Only the authorized signatory needs to be updated in the GST records. That now this will avoid duplication of GST registration, and again the compliance is continued. Previous returns and other things can be accessed by the new RP. Now coming to liquidation. If the RP has not obtained a GST under GST and GST and under CRP, then as a liquidator, you may be required to obtain that because in the course of liquidation, you will be selling plant and machinery and other assets on which the GST applicability will be there. So the GST registration must be obtained in that case. Then once a liquidation commences, the liquidator must inform the GST commissioner about the appointment. Again, similar to what the provision is there in the Income Tax Act. There is a similar provision under the GST Act also, under which we are required to inform the relevant commissioner or the officer under whose jurisdiction the corporate data lies, and that intimation must be sent out by the liquidator within 30 days. Then the department may again file their claim during liquidation. Otherwise, the claim during the CRP itself is considered as a claim under liquidation. Directors may be personally liable if dues remain unpaid because here there is no question of a clean slate principle. The dues have carried forward. If the company fails to pay the dues, the directors may be personally liable during the liquidation, post the liquidation period. Now, as per Section 88, when any company is being wound up, whether under the orders of a court or tribunal or otherwise, the liquidator shall, within 30 days of his appointment, give intimation of his appointment to the commissioner. The commissioner shall notify the liquidator within 3 months from the date on which he receives intimation of the appointment of the liquidator. The amount which, in the opinion of the commissioner, would be sufficient to provide for any tax, interest, and so on. When any private company is being wound up and so on, whether all of these things are there. So this is a provision which is there, which is similar to what we saw under the Income Tax Act. However, by virtue of Section 238, again, these provisions, the 238 will have overriding effect, that is IBC will have overriding effect, and under the public announcement, the department is expected to file their claim within 30 days. However, as a good practice, we must still inform the GST department regarding the public announcement and requesting them to file their claim. Again, Section 82 of the Act, tax to be the first charge on property, notwithstanding anything to the contrary contained in any law for the time being in force, and save as otherwise provided in the IBC. So again, IBC has made an exception here. Any amount payable by a taxable person or any other person on account of tax, interest, or penalty which he is liable to pay to the government shall be a first charge on the property of such taxable person or such person. Now, this is not applicable under IBC because you know under IBC it is not a first charge, but it will fall under the waterfall mechanism. So some judicial rulings under the GST, although rainbow papers is under VAT. However, for some time there was some, I would say, clarity was required on after the rainbow paper judgment whether all the tax dues are going to be treated as a secured charge or not. However, there were clarifications and other things which came out, after which it was understood that it is not, I mean, all the tax dues cannot be given the secured status unless there is a specific provision which is there in that particular legislation, which gives us a secured status to the to that particular government due. So that was later on clarified. Then there are other two cases, Associate Decor and Sundaresh Bhatt, which also clarified about the moratorium. We will discuss those cases. And the courts emphasize the CRP supremacy over tax law. So again, that 238 thing, the overriding effect was also reiterated. Now, in this case, the question of non-recoverability of the exact adjudged dues in customs and central excise matters after the approval of the resolution plan in IBC came for consideration before the SESTAT in Ultratech Nadwara Cement versus Commissioner of Customs Jamnagar. In this case, the tribunal observed that there is no provision made in the Customs Act and the Central Excise Act to give effect to the NCLT proceedings, and this issue has to be resolved by the department. Now, after this, the CBIC came up with a circular in 2022 December, which sought to address this question regarding the confirmed demands under GST and other existing laws and the amount settled under IBC. So this circular refers to Section 84 of the CGST Act, which provides for reduced recovery where such government dues are reduced in such appeal, revision, or in other proceedings. In this case, the CBIC in this circular has explained the expression other proceedings as follows: as the proceedings conducted under IBC also adjudicate the government dues pending under the CGST Act or under existing laws against the corporate debtor, the same appear to be covered under the term other proceedings under Section 84. So all of what was clarified was that all those other proceedings are, or rather the proceedings under the IBC are falling under the term other proceedings by under this CGST Act, and accordingly the relevant notification needs to be interpreted. Now, in the Associate Decor versus Deputy Commissioner of Commercial Taxes, Bangalore, in this case, the comprehensive nature of moratorium was highlighted, which extends its protection not only to the recovery of the taxes, but also to the audit and adjudication proceedings under the GST laws. In this case, the petitioner had sought quashing of the audit proceedings initiated under Section 65 and show cause notice under Section 74 read with 65 and 50 and 122 of the Karnataka local, the Central CGST Act and the KGST Act, where the Karnataka High Court held that in view of the specific embargo or the bar which was contained in Section 14 of the IBC, that is the moratorium, the proceedings initiated by the respondent pursuant to the impugned notices deserve to be stayed or suspended or kept in abeyance till the conclusion of the proceedings before the NCLT, and appeals to be filed if any, and only after the lifting of the moratorium and completion of the CRP process can those be filed. So the moratorium has been held to be sacrosanct in this particular case. So in this case, the Karnataka High Court also referred to its decision in the or rather to the decisions in the of the Apex Court and the Madras High Court. There are some other judgments to the similar effect. However, in Sundaresh Bhatt versus ELT, the Supreme Court has held that once the moratorium is imposed in terms of Section 14 or 33(5) of the IBC, the respondent authority only has a limited jurisdiction to assess or determine the quantum of the customs dues and other levies. the respondent's authority does not have the power to initiate recovery of dues by means of sale or confiscation as provided under the Customs Act. After such assessment, the respondent authority has to submit its claim in terms of the procedure laid down in strict compliance of the time periods prescribed under IBC before the adjudicating authority. In any case, the IRP, RP or the liquidator can immediately secure the goods from the respondent authority to be dealt with appropriately in terms of IBC. So what this case in Sundaresh Bhatt is saying is that the department can take any action whatever is required to assess or determine the quantum of the tax or the quantum of the payables which are there. So to that extent, they can take whatever action is required. However, they cannot undertake any recovery action. So they can assess the dues, they can arrive at how much amount is due from the corporate debtor and accordingly file their claim. However, the next step of initiating any recovery proceedings cannot be done. Again, in this case, Kosamattam Finance Limited, the GST department raided the corporate data after the moratorium was announced and seized some documents. NCLT Kochi held that the search and seizure of the records of the CD and issuance of summons to the RP are violative of the moratorium declared under 14. Respondent was ordered to pay 50,000 rupees as compensation cost to the applicant. And it was also remarked that such unsavory incidents can be avoided if there is more timely clarification and sensitization in the matter. So, like you can see, there are various contradictory judgments. So, one is the case of Associate Decor, which says that nothing can be done during the process by virtue of the moratorium. Sundaresh Bhatt says that they can assess the dues, they can come to a conclusion of the amount, but they cannot take any action on the recovery. So, as of now, Sundaresh Bhatt is because it's Supreme Court precedent which has been laid down. Sundaresh Bhatt is what is the law which is prevailing, that they can take action to assess the dues, but they cannot take any recovery action. So any proceedings which may take place, like the hearings or any assessments or other things which may take place during the moratorium period, as long as they're resulting only into a claim, that may be allowed. However, they cannot proceed to initiate the recovery as long as the moratorium is going on. So this is now the prevailing position. So again, under the resolution plan, we have seen the binding nature of the resolution plan. We have discussed that under the income tax provisions also. Once the resolution plan is approved, then it binds all the creditors, including the government. And any pre-plan claims are not included in the, if they're not included, they will get extinguished because of the clean slate principle. Even if whether the claim is filed, not claimed, if the claim is filed, and some part of it is paid through the resolution plan, then that the balance not paid get extinguished. If the claim is not filed at all, entire claim gets extinguished, depending upon what is the wording in the resolution plan. Practical challenges which may arise typically for the department is difficulty in quantifying the claims when assessments are pending or are disputed. Short timelines under IBC for claim submission, which clash with lengthy tax litigation procedures. However, this I would say, has brought in a discipline whereby they are filing their claims in time, or at least taking the actions whichever is necessary. Confusion with the statutory due should be treated as operational or secured debt. Typically, after the Rainbow judgment, this confusion was there. Lack of effective coordination between RPs and the tax officers, as in the tax officers may not be able to reach out to the RPs for any clarifications, or if they have any doubts about how to file the claim and other things. There is that lack of coordination which is there. As a result of which, the tax departments are often faced reduced or no recovery despite having large outstanding claims. We know that these claims are typically the maximum or the highest amounts after the secured creditors. However, they may not be able to file those claims within time, and they may not be able to enter the resolution process in that. So this was about the provisions of GST. Again, to summarize, the IBC has overriding effect over GST as well as over the income tax provisions in the Income Tax Act. We have discussed the provisions of the Income Tax Act, especially with regard to the duties of the RP, the filing of returns and so on. Similarly, in case of GST also, and the provisions or the safeguards to be built in the resolution plan with regard to the provisions of the Income Tax Act, so as to taking over this company under the CRP. So this is what I had from my side. If we have any questions, we can take that. Or if anybody wants to add their own experiences or their own comments, we can do that now. Madam, I guess there are no questions. We can conclude if you're there.
Are you there?
Madam, are you there?
Yes, ma'am. Shall we conclude?
Yes, ma'am. I don't think there are any questions. We can conclude.
Okay, thank you very much, ma'am, for giving
you,
your
ma'am. Thank you.
valuable time and share your learning and experience in the topic. Thank you very much, ma'am.
Thank you, ma'am. Thank you for the opportunity. Thanks everyone for a patient hearing.
Bye-bye.
Thank you.